Good morning, student. Today, 10 July, Friday, Part 8, Lesson 14, Accounting Principles. This is the very important lesson because all the policies related to the accountings, rule, regulations are mentioned in this lesson in a theoretical way. So, all of you pay attention, especially give the focus on this chapter. Meaning of accounting. Account in accounting, every business firm follow a definite rule and regulation. These rules and regulation are man-made. According to need, time to time, accountant adopt a definite policy, or if this is good for the business, he advised to other businessmen. Other businessmen, when they find this is the comfortable, relaxable and reliable, they also start to follow this pattern. And in this way, it is accepted by the all the business firm automatically. And when all businessmen brings this in the practice, in that case it becomes as a principles. So their problem has come that so many concepts were. That is reason Indian government give the full authority to the Institute of Chartered Accountant of India to develop a definite policy which are mostly accepted by all the businessmen, so that there may become a uniformity in same types of business. So ICI issued the guidelines which policy in which business they have to adopt one. But always keep this in mind, policies first they come in the practice, then the ICI approved this one. Or either with the consult of the businessman or Chamber of Commerce, ICI developed the new policy. There are the two types of accounting principles or policies. First, the concept or assumptions, and second is the assumptions. there are the some concept and there are the some assumption. This is the concept and this is the assumption. Assumption means the accountant will not mention that he has followed this or not followed this. It will be always considered that every business firm has followed these. Like first, going concern. It is assumed that the business will be continue in the future. This concept is called going concern concept or assumption. In this, we consider always the business will be continue. It is not going to stop one. Consistency. It is assumed that which policy has been adopted this year, that same policy will be adopted in the next year. So same policy will be continue in the future. This is called consistency. And third, accrual. Now means when the ownership of the property is changed, the transactions are considered as a complete one and they are recorded in the book. Either the physical delivery has been made or not made. For example, you have purchased a TV, make the payment to the seller. Now the ownership has been transferred from seller to you. Anytime you can take this dispatch, but you have not taken this one. You have told him you will take the delivery after 3 days. But this transaction has been completed and he will be recorded as a sell. So when the ownership will be transferred, it will be recorded and this is called the accrual. Secondly, now concept, accounting entity concept. This concept consider that business firm and owner both are the separate one. That is reason all the personal expenditure of the businessman are recorded with the name of drawing, and all the amount whatever the businessman invests in the firm, that is called capital. Now this capital account or drawing account is mentioned to the owner's personal. It is the owner's account. So firm account is separate and owner's account is separate. Due to this concept, capital is recorded at liabilities side. It is considered that whatever the amount the owner has invested into the firm has liabilities to return this amount again to the owner when the business will be closed down. Next, money measurement concept. According to this concept, only those transactions can be recorded in the accounting book which have the financial nature and which can be measured in the terms of money. If they cannot measure in the terms of money, they will be not recorded in the accounting book. According to this concept, we not record the honesty and faithfulness of the employee in the accounting book. While the helpful nature, faithfulness for the firm, honesty for the work, these are the very important for every institution. Accounting period concept. According to this concept, from 1st April to 31st March, this is called financial year, and all the accounts are closed on 31st March every year. Either they have opened on 1st April or any time between this the year. Suppose you purchase the furniture on 25 March, but the furniture account will be closed on 31st March after 6 days. So, according to accounting period, all the accounts are closed on 31st March, and it starts from 1st April. So, April to March, this is called the financial year, and this period of 12 months is called the accounting period. Matching concept. According to this concept, we calculate the net profit or net loss. For a particular period, income and same period expenditure are compared to one another. If income is more than expenditure, it is the profit, or income is less than expenditure, it is the loss. Next, historical cost concept. According to this cost concept, whatever the real price we pay to purchase any assets, only that amount we will be recorded in the accounting book. There is not matter either its real value is something more or something less. For example, you know this particular sofa cost is 15,000 in the market. But when you go to the shop and you find that your old friend is sitting there, who is the owner of this shop. Now he gives you this sofa only for 13,000. So you will record only 13,000 in your accounting book. You will not record 15,000 in your accounting book. So whatever the real money you have paid, only that amount you will record in the accounting book. So it is called historical cost. Why historical? First we make the transaction, we pay the money, after then we record. So it has become as a history. So we call this historical cost. Next one, dual aspect concept. According to this concept, for every transaction, one account will be debit and other account will be credit. This concept is based on the accounting equation assets equal liabilities plus capital. Now, throughout the accounting is based on this concept. All the software of accounting are developed on this concept assets equal liabilities plus capital. So for every transaction, here we make one account debit and one account credit. Due to this concept, the total of trial balance debit column will be always equal to the total of trial balance credit column. And same in the balance sheet, total of the liabilities and capital always will be equal to the total of the assets. Thank you.